I know for sure that some of them thought I lost my mind.
And I'm back with another Michael Burry video. Man, this guy just can't stay away from the spotlight, can he? But his revelations now are as concerning as they've ever been. The founder and CEO of Scion Asset Management, Michael Burry, has pointed to signs of rising velocity and a declining money supply and suggested that this may be a precursor to higher inflation. This stance is potentially at odds with recent views from Elon Musk and ARK Investment Management's Cathie. In this time of uncertainty, with inflation at its highest in 40 years, investors and companies are looking for any sign that could save them from the worst. People are wondering whether to believe in Michael Burry's predictions or not. Stick around until the end of this video to know what Michael Burry has said about declining money supply and threats of deflation. Burry, the investor made famous by Christian Bale in the 2015 movie The Big Short, said that in the late 1970s, rising velocity, the frequency at which money moves through the economy, trumped falling money supply to drive inflation higher and higher. On the other hand, the Federal Reserve, or Fed, has promised to continue to aggressively increase its interest rates to tame this rise in the prices of goods and services, which has a clear impact on the purchasing power of households. Burry tweeted that quantitative tightening and rising interest rates are starting to push M2 down. He went further to say that we're seeing a tick up in velocity, emerging from narrative obscurity. In 1978 and 1979, the effects of rising money speeds overcame the decline in money supply, accelerating inflation. Super high inflation and an economic recession. Burry has been persistent in pressing that the future holds both of these challenges for the USA. But is there any truth to what he says based on what's going on in the world? You know, the usual plagues, climate catastrophes, and wars. Burry's words may be more than just an alarmist crying wolf. He did, after all, predict similar crashes in the past, didn't he? But let's address the obvious first. Burry's view could run counter to views recently expressed by ARK Investment Management CEO Cathie and Tesla CEO Elon Musk. Cathie claims that we're seeing a lot of deflation in the pipeline already. In response to Wood and a Twitter user who asked what the Fed would do, the world's richest man, Elon Musk, earlier this month suggested that the Federal Reserve should cut interest rates, warning that a major hike might risk deflation. Musk, tweeting Cathie says Fed should drop 0.25%. Wood also tweeted this week that US central banks' rate hikes are significantly more restrictive than in the 80s, when Fed Chairman Paul Volcker hiked rates as high as 20% to quash price pressures. The current chair, Jerome Powell, last month evoked the Great Inflation of 1979, as he said that period provided lessons on the need to keep at it until the job is done when it comes to taming inflation. Phew, that's a load off our heads. Or is it? Well, not for Burry. By the way, do you want to stay updated on Michael Burry's predictions? Then give this video a thumbs up and hit the subscribe button. It helps me to grow the channel and bring you the best content about investing. Burry keeps on tweeting on the issue of deflation concerns, highlighting the potential that they're having little impact on bond yields because the Fed's decision to trim its balance sheet is more important. In addition to raising short-term interest rates, the Fed has also picked up the pace of its quantitative tightening program this month. Quantitative tightening is what the Fed is using to reduce the size of its balance sheet, which reached nearly $9 trillion at its peak earlier this year. It's allowing the bonds that it holds on its balance sheet to mature without replacing the full amount. When a bond matures off the balance sheet and isn't replaced, it reduces the number of reserves in the banking system by an equal amount. So the idea here is to tighten the availability of money, which should raise borrowing costs and slow economic growth. There's no set time frame or target level for the balance sheet reduction, but Fed officials in the past have specified a preference for holding only treasuries at a level close to 20% of gross domestic product, compared to the recent peak of about 35% of GDP. That could take some time and involve reduction of approximately $3 to $4 trillion, which would likely be spread out over several years. Inflation has prompted the Federal Reserve to boost short-term interest rates aggressively, and that has had an impact on many longer-term bonds as well. So this implies that money supply is being decelerated because of the Fed trimming its balance sheet, unlike what Burry has suggested. In a recent tweet, Burry said the Fed is so afraid of being the Fed of the 1970s that they're becoming the Fed of the 1930s. And that is pretty damning. If we take a look at the 2-year Treasury, yields are poised to crack above 4% for the first time since 2007, lifted by the Fed's steepest tightening cycle in a generation. The yield on the benchmark 10-year Treasury rose to 3.814%. The note has had a highly volatile week, rising to a near 14-year high before seeing its steepest intraday decline since 2020. The policy-sensitive 2-year Treasury yield rose to 4.264%. An index of US sovereign securities extended its worst year since at least the 1970s, after St. Louis Fed President James Bullard warned the central bank has to keep raising interest rates to retain its credibility. On top of that, US debt is also under pressure due to speculation the sliding yen will compel Japan to conduct more intervention, potentially funded by Treasury sales. That is to say that recession today seems to be a global concern. For instance, Japan may have bought a record 3.6 trillion yen or $24.9 billion to prop up its currency, estimated from central bank data. That represents about 20% of the cash component of the nation's $1.1 trillion in foreign exchange reserves, fueling concern that the nation will have to sell some of its treasury's holdings. In other words, week by week, the bond market crash just keeps getting worse and there's no clear end in sight. With central banks worldwide aggressively ratcheting up interest rates in the face of high inflation, prices are tumbling as traders race to catch up. And with that has come a grim parade of predictions on how things can get even worse, like Michael Burry's recent statements. The Bank of England is also in troubled waters after it staged a dramatic intervention to stave off an imminent crash by pledging unlimited purchases of long-dated bonds. With the fallout from Prime Minister Liz Truss's tax cuts still ripping through UK asset prices, the central bank has been warned that collateral calls could force investors to dump government bonds. The Bank of England kicked off the plan by purchasing just over £1 billion or $1.07 billion of securities maturing in 20 years or more, less than the £5 billion it said it was prepared to buy at each auction. Operations will continue every weekday until October the 14th of this year. The plan to buy long-dated bonds in daily tranches of up to £5 billion or $5.3 billion had an instant effect on the market, putting yields on 30-year debt on track for the biggest drop on record. They earlier climbed to the highest since 1998. The central bank warned that continuous dysfunction would threaten financial stability and even damage the economy. It also delayed the start of its plan to start actively selling its existing holdings of bonds. The Bank of England decided to intervene to get ahead of a potential crisis that could have hit within hours. It was concerning collateral requirements on liability-driven investment strategies. Seems chaotic enough, right? Michael Burry has been pointing towards a market deflation of unprecedented size and scope since last summer, and has warned the investors buying into the hype and speculation to brace for an historic crash. He highlighted the risk of inflation as early as April 2020, and ever since, he's repeatedly issued warnings with his tweets. But what do you guys think? Do you think Burry is right to worry? Write history repeats itself if you think so, or write broken clock if you think he's just sowing panic for nothing. If you enjoyed this video, make sure to watch our previous video about why Burry sold his entire portfolio, and don't forget to click that subscribe button. I make videos like this every week where I uncover the secrets of money and markets.